Sounds good. Let's have a look. Let's see where the numbers are coming from. Let's see where the numbers are going to. On the first day of the accounting period, we issue a deep discounted bond with a nominal value of 50. The discount was 16% of the nominal value, and the issue costs are 2. The nominal value coupon rate is 5%. It's a 5-year loan redeemed at a premium, and the effective rate of interest is 12%. You will always be given the effective rate of interest. You won't have to calculate. I want to be able to deal with the initial recognition, and the initial recognition is at the net proceeds of issue. The gross proceeds of issue are not 50,000, but at a discount of 16%, which gives me 42,000. However, I don't get 42,000 because of the issue costs, and the amount of the issue costs are 2. So therefore, my net proceeds of issue are 40,000. The net proceeds of issue are 40,000. Opening balance, 40,000. What happens to my liability is that there will be a finance cost, and the finance cost is 12%. 12% of that is 4,800. 12% of that is 4,800. Hey presto, I have done one of my figures. The amount of cash that I pay is 5%. The amount of cash that I pay is 5% of 50,000. 10% would be 5, this is 2.5. So therefore our liability is 40,000 plus 4,800 minus 2,500. Our liability is 42,300. So therefore I have as a balance sheet liability 42,300. That are my numbers. Now look, I'm just pausing for a second. We've done the first year. I'm done. I'm dusted. There's a couple more things I would like to say. If I borrow money and I account for it at amortized cost, that is my finance cost and that is my liability. If I lend money, then that becomes my asset and that becomes my finance income. So amortized cost is two sides of the same coin. Because if you borrow money, you have a finance cost, but if you lend money, you have finance income. And one of the things we will do next time is looking at financial assets. But if you can understand amortized cost, then financial assets and amortized cost behave in the same way. So it's a good thing to understand. We don't trade the liability. We're not interested in the fair value of the liability because we're just going to gradually pay it off. So there will be some assets that we never trade. So if you've got a financial asset that you're never ever going to trade, that you're just going to collect the money, the principal payments of capital and interest, if all you're doing is collecting the principal payments of interest and capital, then you can have it at amortized cost. And that is something that we will look at next time.
So there should be a current liability also, right?
No, I don't think so. I don't think so. Finance leases, yes, but what's happening with your liability is your liability is getting bigger every year. So because your liability is getting bigger every year, you're not paying any of the liability off. Look, the interest is not washing its face. This is less than 4.5, less than 4.8. So you're not paying the finance cost, all of it. So you're not paying back any capital. So the liabilities you get bigger and bigger and bigger and bigger. All of this is non-current. So with financial instruments, this is what you tend to find. The effective rate will be the higher rate. There's always an effective rate. Sometimes the cash is zero. Zero coupon bond.
So if we do second year calculation,
If you do a second year calculation, which I know some of you have done, and you'll get a figure here of 44.
yeah.
Yeah? Because if that's 40 and that's 42,
Okay.
you know, this is going to be 2.5 again. This will be about 5 something. So this will be about 44, 500, 44.
876.
Yeah. And that is a bigger number. So all of that is non-current. Yeah? Got it? Now, homework. You have homework in the sense of I have given you a question which I would like to have a look at. Some of you have given me the answer for me to have a look at, for which I thank you. Some of you are going to give me the answer next time. Some of you are going to send me the answer. Some of you have asked already if you can see the answer. Now, I'm not going to hand out the answer to everybody, but if you do want to collect a copy of the answer, then I do have copies of the answers here, if you want to collect them. I'm not going to hand them out. I'm simply going to leave them there for your perusal. Your material does include homework questions. There's a certain amount of initiative that is required because we don't do every example. You can go back and have a look at particular examples that we haven't done. But if you look at page 441, from page 441 onwards, there's a whole series of homework exercises. Yeah? So for each little chapter, for each little segment, there is a homework exercise to be done. And therefore I would encourage you, please, to keep ticking over. We are ending slightly early tonight. Yeah, we are ending slightly early tonight. When I see you next time, yeah, I will bring with me, I will have available the revision material. So when I see you next time, we will continue with financial instruments, and I will bring with me the revision material, so you can collect that revision material next class. We do have revision. It is a late revision, and I will give you some extra instructions and extra support to help you prepare for the revision class, so we can make the most of the revision phase. It is at the end of November, I'm aware of that.
Good night. Wow.
So